So everybody that's here, as usual, appreciate those that keep coming back to these daily conversations. This should be a very good conversation with Mark Moss, who's got a phenomenal following, just put a book out as well. And if you don't subscribe to him on YouTube, you unequivocally should. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour, Mark Moss, who, again, as I mentioned, has a hell of a following and story here. Mark, for those who are not familiar with you, obviously social media networks tend to have their own audiences. So for those who don't know about you and the success you've had in growing your YouTube channel, just talk about your background. How did you get involved in markets? What got you to even start a YouTube channel? And what are you doing now?
All right. That's a lot. We'll move.
I got to keep it very open.
We can spend a lot of time there.
Keep it very open-ended.
Yeah. So, I started my career as an 18-year-old, my first foray into business, buying bank-owned repos. So I jumped right into the deep end of the pool in Southern California, coming out of the 89 to 92 crash. Really the only time real estate had crashed in California. I dropped about 30% over those 4 years. And the banks were sitting on tons of properties they couldn't get rid of. By 1995, they were still sitting on so much inventory, they would basically give it away for free if you would just pay the closing costs. So literally they'd just say, take it, zero down. And I was 18 years old and had a buddy that was doing it. And I was like, well, it looks like a pretty good idea. So I started doing it. So jumped right into kind of real estate investing, fixed and flipped over 100 properties, started developing properties, mixed use buildings, commercial buildings, big properties, hundreds of units, et cetera. But when 2008 came, so from about 1995 till 2005, I was crushing it. I was the smartest guy in the world. I started two different businesses. I started investing through the dot-com boom as a kind of an important corollary. Late 90s, invested into these crazy things called internet stocks. My roommate had quit his job at the time, and we were at home and trading these internet stocks every day. It was like this foreign language. Nobody knew what they were. Then the dot-com boom happened, or the bust happened, I should say, 2001. I thought it'd be a great idea to start this internet business and e-commerce business. I was going to sell products online. And I built this e-commerce store 2001. It was not easy. There was no Shopify. There was no WordPress, none of that. So I built this e-commerce store. It cost me like 25 grand to do that. And I went to these companies. I said, hey, I want to sell your products on my website. And they laughed at me. And they said, no one would ever buy anything online. That was ridiculous. And I was like, okay, well, I beg to differ. And I have this website. Anyway, built that company up. I built up a medical equipment company, had Fortune 500 exit. Basically, I thought I was really smart and I made a bunch of money. 2008 came and I got just blown out like millions of other Americans did. And it made me realize I'm pretty good at making money. I've got this kind of business side figured out. But what the heck is this whole financial casino system that the Federal Reserve is running that has control over my life? And I don't know anything about that. And that was a turning point for my life. And I just got married, just had kids. I just built this custom home. I was on top of the world. And next thing you know, I got to kind of start all over. And I very quickly learned the problem with the fiat money system that we have today. I became a gold bug, we need sound money. That's the answer. We can't have this unlimited money printing. We need a fixed money supply kind of a thing. And I started going down that rabbit hole. So that's 2008. I learned this concept that money is like energy. Money doesn't disappear, it transfers. And so that means when I lost all my money, somebody else got my money, which didn't sit real well with me. I didn't like that, being a competitive person, but I also realized I could also use these opportunities to funnel money towards me. So I don't have to be on the giving end, I could be on the receiving end. And so I vowed I'd always be on the receiving end from then moving forward. So the last 12 years, I've studied these phenomenons called wealth transfers. They happen under times of market crashes, bear markets. They happen under different types of cycles, demographic cycles or technological revolution cycles. And so we're seeing all of those things happening today. And so, I'm fast forwarding through this. So then 2008, I started 2015, I started buying Bitcoin because I saw it as a way to pull money out of the financial system. I was trying to diversify my money. So just like I wouldn't put all my money in one stock, why would I put all my life in one country or one banking system? So I was trying to just international diversification, started buying Bitcoin. By 2016, I started talking a lot about it, started writing a financial newsletter, started making videos. 2018, I launched the YouTube channel. And I guess you could say I've just never shut up since.
I'd say your story reminds me a little bit of George Gammons. I had him on a space and he was on the real estate side for a while, was an entrepreneur like you, quite successful, then did the YouTube gig, and both you and he have utterly blown up. And I've only myself recently started taking YouTube more seriously by having these spaces edited on the channel. But I think people underestimate how difficult that platform is to grow and get attention on.
Well, George Gammon is actually one of my really good friends. We talk all the time. I mean, we weren't friends previous to both of us being on YouTube, but now we do a lot of stuff together. We actually did our very first event together. He has his conferences, Rebel Capitalist Live, and I always speak at them. And I have my own events called Market Disruptors Live, and he speaks at my events. So we're good friends from that perspective. But yeah, I think a couple things to point out there. I think for one, there's like 3 levels to learning, right? So there's like the learning, the reading, then there's the doing it, and then there's the teaching it. And so like being on YouTube or just being on social media overall, like you gotta really perfect your positions, because you're gonna have thousands of people coming out to challenge them. And not that I always have to be right. I'm happy to be proven wrong if that be the case, but it just really makes you think through what it is that you're learning, what it is that you're doing, and so that you can teach it. I try to do, he does as well, but I kind of try to pride myself on taking these really complex things and making them very easy to understand. So that's kind of my little catch. He's a little more technical. He likes to stay in the weeds a little bit more. But I figure somebody watches like a video or they read the piece and it talks about the repo system and all this, the repo system's moving up, the treasury account is moving up, and like they watch that and they see this crazy schematic of this inner workings, the plumbing of this financial system. But then they're asking themselves a question like, okay, but like, what does that mean, right? What does that mean to me? And so that's what I try to answer. And so, yeah, it helps me kind of perfect my thinking. Well, I shouldn't say perfect, but improve my thinking, sharpens it up. And it's been a lot of fun. It is a lot of work, to your point. It's a big commitment, but it's also a lot of fun.
All right, so let's go with that turning complex things into things that are easily digestible, understandable. In your own studies, as you look at markets, you look at economies, what's something that you think people believe is overly complex relative to the truth behind it, right? In other words, what's something that really is simple, but there's just a cloud around it in terms of how to think about it?
Well, I mean, shoot, we could start at the top, and I would just say the entire financial system looks very complex, but it's really not. And so what do I mean by that? I put out a Twitter thread, I think just this morning. I wrote it yesterday and I had scheduled to go out. It was going to go out this morning, and basically saying just that, right? Like we have all these economists and they try to make it all sound really, really complex and really, really complicated. And so we need all these PhDs to help figure it out. And how can they get the right amount of inflation? And how can they set the right price of the bonds? And how can they get all of this just working right? But the reality is it's actually really simple. It's just basic logic. They overcomplicate things in order to, one, sound really smart. And so we depend on them. We kind of just say, okay, fine, you're the expert, you deal with it, so to speak. And then it also sets up really nicely for the financial advisors, because it's too complex for us. Let's just hand everything over to a financial advisor, let them deal with it. So I'd say, starting at the top, the whole thing is way too complicated and it really shouldn't be. So I guess we can stop there for a second.
So let's continue with that. So because that's a broader sort of cultural, societal aspect, which I've noticed too, right? Which is that there's this abdication of personal responsibility because things are so complex. So you rely on the quote unquote experts who are in the weeds, but in reality, a lot of that may just be obfuscation.
Yeah. So that's exactly true. And that actually dovetails into the book I just released called The Uncommunist Manifesto, as well as just kind of my worldview of where I think we are in the world from a greater kind of macro geopolitical lens. And so I've been talking about like this bear market for freedom, or I've made several videos talking about this blow off top of socialism. And this fits into that because what's happened is in a market, if you look at the dot-com boom, you look at the Bitcoin run up in 2017, or any other bull market that you want to take a look at, what you see is that the market stays relatively flat. It's kind of gaining steam. And for any of you guys listening, you might have seen before like this Wall Street psychology cheat sheet. If you haven't, you can just Google it and see what I'm talking about. But it basically it kind of gives this investor sentiment as these market cycles move up. And so as market cycles move up, it starts sucking more people in. Very simply, again, making things super simple, markets stop going up when there's no more buyers, and markets stop going down when there's no more sellers. And I know that sounds overly simple, but it's true. So take a look at any market. So if we look at like Again, back to 2017, the Bitcoin boom, the Bitcoin run up went from $1,000 to almost 20,000 within that year of 2017. And what happens is, as it starts going up, it moves from 1,000 to 2,000, and people start talking, and more people start buying it. The self-fulfilling prophecy happens. It starts moving up to 3,000, 4,000, which then sucks up even more people. Oh my gosh, I doubled my money in 30 days. More people start buying. Oh my gosh, now I doubled my money again in another 30 days. More people buy. And it starts sucking more and more people in, like this vortex. And it goes into this almost vertical, like what we call parabolic run. And you can see the price of Bitcoin, or you can look at the housing boom or the 2000.com boom. And it starts sucking more people in, faster, 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 faster. The price goes, and it almost starts going straight up. What happens is it starts running out of buyers. Right. So the Bitcoin cryptocurrency space was still young in 2017. And what happened in December of 2017 is both Google and Facebook shut down all advertising for anything related to cryptocurrency. And then the banks shut down all ability to send money into exchanges. You couldn't buy with credit cards or anything like that anymore. So they basically took away the buyers. Couldn't advertise it, and you couldn't buy it. And so then what happened is it starts to get really volatile, boom, 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 up and down, up and down, up and down, and then boom, the blow off top, and it crashes down. And so you see that happen in the real estate market. You see it happen in 2007. You see it happen in Bitcoin, et cetera. But I think we're also seeing that in the instances I said, is we're all handing more responsibility back to the state, right? So, hey, just handle my education, handle my retirement, handle my healthcare. And we just hand off everything, just shrug that personal responsibility. And the state's gotten bigger, 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 bigger. But there's no more buyers. There's nothing else to give to them. I mean, they're trying to take over energy and agriculture right now, but it's like very volatile right now. We can see around the world, we have protests happening all over the world. We have fiat currencies are crashing all over. We have countries going down left and right. I mean, we've had half a dozen countries just fall off a cliff in just the last couple months alone, right? And so it's very volatile at the top, and we're about to see that blow off top. So that's kind of like part of a big thesis, a framework that I'm using right now.
All right, so we're going to expand on that in a bit, but I want to bring in some of the audience who, as I noted before, asked a question. So go ahead, unmute yourself. And maybe, Mark, have that dovetail with your bigger thesis in terms of technology and some of the things you and I kind of went back and forth on. I saw a YouTube video on it, and I think it's interesting, but maybe explain that and dovetail that to Dave's question here.
Well, when I hear a question like that, I mean, I have to kind of clarify that a little bit, but I guess you're talking about probably typically trading. So this is kind of like day trading these typically probably stocks, or maybe you're referring algos to cryptos. I'm not sure what you're trading, but obviously when you're trading either stocks or cryptos, you're working against algos, right? When you're trading stocks, for sure, you're dealing with high frequency traders. One thing I'd say when it comes, so first of all, I think things are overly complicated. I think most people should not be trading. So that's maybe contrarian in this room. But again, things don't need to be that difficult. Most people should be focusing on creating wealth, and they do that through their business, through their work, whatever. And then you take that wealth and then you use that wealth to, preserve it and grow it. And you can do that by putting it into investments, right? But most people should not be trading, trying to earn income that way. I think it's, 98% of people fail doing that. And so when you're trading, you're going up against the algos, to the point of the question. Now, if you're doing it in stock market, you're going against high frequency traders. Now, when it comes to investing, or business for that matter, you should always have an edge. And each of us have a different edge, right? We know something, we have a certain skill, certain thing like that. If you don't know what your edge is, that means you don't have an edge. And that certainly means you shouldn't be investing. So if you're trying to invest in the stock market and you're worried about algos, for example, you're right. You don't have an edge. They have high frequency traders. You'll never work against that. And in the crypto space, it's not quite as advanced, but it is pretty advanced. And there's lots of different algos working there. So right off the bat, I would say don't trade. What I do is I look for bigger trends. So I'm a surfer. I look for a storm happening in the South Pacific. I study that storm to see how big the seas are. I see which direction it's going to send those waves. And then I'll go move to where those waves are. I'll go down to Mexico or Central America. I'll wait for those waves to come and I'll ride. And so when it comes to investing, if you look for some of these big event-driven notifications that you might see, and then you can position yourself. For example, what you can see over the last month is this massive shift, and really just last couple of weeks, but maybe the last month, this massive shift towards uranium and nuclear, right? All of a sudden, reality is smacking all this ESG people in the face. Germany's turning their nuclear reactors back on. In California, Governor Newsom decided not to shut our nuclear reactor off. The European Union just said that uranium is green. Like, that's a big trend. Now, that's not going to happen in the next couple of weeks or next couple of months, but that's a trend that I could buy into, that over the next 5 years, next 10 years could be massive. And so back to kind of this, how do you go against the algos in my thinking of trading? A quote that I'll leave you with before I take a break is Charlie Munger, Warren Buffett's partner, says that the big money is not made in the buying and the selling. The big money is in the waiting. And so you wait for your opportunities, you move into positions early, and then you wait and you allow them to develop.
A lot of your work, Mark, is correct me if I'm wrong, around cycles and longer cycles in general. And again, I know in your YouTube video you talk quite a bit about this, but talk about some of the longer term cycles that you've focused on the YouTube channel and a lot of your content for the audience. What are the things that, from a really big picture perspective, are happening that most people are just unable to see because it's such a bigger, slower moving type of trend?
I have a whole playlist with a bunch of videos. I break down 3 different cycles that are converging right now, and I have there's a video for each of the cycles, so you can go deep into that if you want. But basically, 3 cycles that he's referring to is a political cycle that happens on a 250-year time frame. And then on an 80-year time frame, we have this financial revolution cycle. And so 80 years ago was the Bretton Woods Agreement, and we're kind of witnessing like the first sovereign grade debt bubble we've seen in about 80 to 100 years. So we can see that's changing. And then what I think is the most important is the third one, which is the technological revolution cycle. So about every 50 years, on a 40 to 60-year time frame, but I say every 50 years, we see a technological revolution cycle. And what we can see when we look back through thousands of years of history, it's technology that really changes things the most. And so I think that's the most important, because he has a whole team, an army of that. But I think he overlooks this technology piece, and I don't think you can do that. And so those are the 3 cycles. Now, when you look at the way the world is developing right now, this 250-year political revolution cycle tells us about every 250 years, this pendulum basically swings from centralization back to decentralization. And so right now, the pendulum has been swinging towards centralization. I already talked about that. Right? This kind of rise of socialism, this blow off top that we're going into, where everybody's just handed all the responsibility back to the state. And we can see we're at peak centralization, of course, World Economic Forum, World Health Organization, World Trade, et cetera. And so we can see that very clearly, but we can also see that people are rejecting that left and right. Now, before the pandemic, this is not a black swan event. Before the pandemic in 2019, there were 10 countries with over 1 million people each in the streets protesting. So everybody's pushing on this centralization, and it's failing. As that's happening, the world is moving back to decentralization on a 50-year time frame of a technological revolution. A technological revolution is a lot different than just a new technology. A new technology is like an iPhone, which is an improvement offer. It takes a phone and a computer, puts them together. That's cool. It helps. I like it. I use an iPhone all the time. Don't get me wrong. But a technological revolution is different in 2 main ways, and 2, it drives financial markets. There's only been 5, so it's easy to see them. We had the Industrial Revolution, late 17th, from the farms and factories, put them in cities with machines that could do the work of 5,000 people, change the course of humanity. When I freed up all that time, now they could go into specialization of labor. They can go into science and medicine. And the world exploded. Then we had steam engines and railways. Of course, all of humanity, we could just carry stuff on by hand or by horse. And now we have steam engines to move stuff across continents. Then we had electricity and steel. I don't have to tell you how big that was, of course. Now we can build skyscrapers, bridges. We have electricity. Then we had oil, automobiles. All of humanity, people walked and rode horses. Now we had transportation. 1971, age of the microprocessor, which brought us telecommunications, personal computers, etc., the internet. And now, 50 years later, we're witnessing another one. Now, the other thing I'll point out...
Mark, real quick, because I'm seeing other people are saying the same thing. It looks like there's some kind of connection issue on your end. You sound a tiny bit robotic. I don't know if it's maybe your Bluetooth headset, but if there's anything you can do on your end.
Okay, sorry. I'll walk away from my computer. And then the last thing I say is the technological revolutions, they change the course of humanity, but they also drive financial markets. So what's driven the financial markets over the last 50 years? Telecom, internet, computers, right? What drove it before that? Ford, GE, GM. What drove it before that? Oil, steel, right? So you start to see how that plays out. Now, what's interesting, when you look at this from a geopolitical lens today, we can also see that the world is starting to break apart, like I said, just on plan and just on this time frame that we're expecting. And so then we start to go, okay, the world is changing. The money supply just got assassinated, right? The financial system that we have. So the financial system that we have, the US dollar, really what it is a payment network. It helps us move payments around the world. But we saw really quickly that people are starting to lose trust in that system. It's been happening over a long time frame, but it's happened much more rapidly through the Canadian trucker situation that happened, freezing, seizing people's bank accounts. It got escalated much more rapidly in the Russia situation when the FX reserves were seized. And so now we have a situation where people can't trust the money. We have the world breaking apart. We have, of course, the BRICS nations. Now we have other nations, Iran, Argentina, joining the BRICS nations. It's about 50% of the entire world's population now are part of the BRICS. And so we can start to see the currency system, the payment systems are starting to break apart. We're starting to see, obviously, there's been this big rotation of stocks and growth and moving into commodities. So we're starting to realize that with unlimited money printing, we need real, hard, tangible things, assets, commodities. And so I think that sets up a whole lot of investment trends that are big trends that we can move into early. We can take positions in and we can allow them, we can wait for them to come to fruition without, back to kind of that first question I had, which is without having to be trying to beat the algos on a daily trading basis. Yeah, so good question. So, I told you kind of my quick story. I started writing a financial newsletter in 2016. It was actually a cryptocurrency research newsletter from 2016 to 2019. I personally researched and published over 1,000 pages of data on all these different cryptocurrencies. And today, starting in 2019 and still today, I only focus on Bitcoin. So we're pretty clear to say, Bitcoin, not crypto. So I think there's a difference there. And the reason why is because some of those buzzwords that you use, like trust, for example. And so what I believe is that the real revolution that's happening here is decentralization. So instead of having one database like Facebook that controls a database, which is a ledger, right? So somebody keeps track of that ledger. The problem is whoever tracks that ledger, I have to trust them. So you use that word trust, and I use the word trust as well as our currencies. We don't have trust in the currencies today anymore. And so whoever controls that ledger, I have to trust them that they control that ledger properly. But of course, we've found out time and time again, whoever controls the ledger typically leads to manipulating that ledger. And so what we want is a decentralized system that has a million ledgers that nobody can control. And so that is the real revolution that we see happening today. And now instead of having trust, we have something called trustless. We don't have to trust anything. We don't have to trust anybody. So I think that's a big, massive shift. Now, when we have a technological revolution like electricity, for example, there's always a first killer app, a killer application. So what was the very first application of electricity? Of course, it was a light bulb. And so imagine at that time, if you said, hey, what is this electricity thing? I don't understand this thing. Well, it's like a digital candle. Well, what the hell do we need that for? Candles have been light for 5,000 years. Look how much better they are. They're portable, right? And it was that, but it became so much more. And so I think right now we're seeing Bitcoin and this decentralized ledger, this trustless ledger, we're seeing the first killer application is, of course, money, but I think it could eventually lead to other things. And so new technologies, humans were really we're not good at imagining the future. We can only imagine better versions of what we have today. But what happens is when we get new building blocks, we can build things with it. So with steel, for example, gave us a new building block to now build skyscrapers and bridges. And we're already seeing the Bitcoin time chain. I'm starting to call it the time chain. In the Satoshi white paper, it was actually called time chain, not blockchain. And in this time chain, we're already starting to see that being used for other things. So like, for example, Jack Dorsey's company is now working on these decentralized IDs, and he hashes the decentralized identifier in the Bitcoin time chain. So it's a base that we can build new things off of. So back to the question, is this like something to invest into? I certainly think so. I think Bitcoin is probably the best risk-adjusted investment we could make today. I could break it down, but I think about an 80 times X upside. And I guess you could lose it all. So you have a 1 times X downside. So a 1X down, an 80X up. I think that's pretty good. I like those odds. And then we have all these different types of companies and services that are being built on top of it that I think are amazing opportunities as well.
Help me out with something on this, Mark, because I think this is just real quick. It's something that has bothered me. And it's funny because I often rant against narratives, especially the whole store of value bit, which now nobody says given the drop in Bitcoin. The dilemma that I have with the narratives around Bitcoin, I'm down with the trustless ledger, and unequivocally that's a game changer from a longer term perspective. But you end up having this sort of extreme mentality and overconfidence that Bitcoin is going to take over the world literally tomorrow. And the problem there is that overconfidence creates a tremendous amount of leverage. And that leverage then creates the conditions for a crash, which I would argue then delays institutional adoption, right? Because the more volatile an asset class is, the harder it is for institutions to take a sizable, meaningful allocation, to really kind of move the needle. How do you think about this question of, yes, it's trustless in terms of the ledger, but you can't necessarily trust people to take on the right amount of weighting in a portfolio, especially when you have leverage involved.
Yeah. So good questions. So first of all, I would say, is that really a bad thing? Because it sounds like a good thing to me. Let me break that down for you. But before I do that, I want to say, I'll start there. So, first, let me jump back to the first statement that you made. It's a horrible store of wealth. It's proven that. So what I would say to that first part of the statement is, let's take a look at that. So first of all, we have to understand that new technologies, especially technological revolutions, they don't happen overnight. So there's something called the diffusion of innovation, and it measures how fast technology reaches adoption. And so we can see like telephones, when they first came out, took about 90 years to get to 80%. About 80% is considered full adoption. So it took about 90 years, but each new technology has a faster and faster adoption period. But of course, it doesn't happen overnight. What we're seeing is Bitcoin, each one builds on top of the next. And so Bitcoin is reaching a much faster adoption rate. We reached about 10% adoption within the first decade, which means use an S curve. That means however long it takes to reach 10% adoption is typically the same amount of time it goes from 10 to 90% adoption. So we see by the end of the decade, we'll probably be to about 80 to 90%, which would be considered full adoption. So I say that because to the point that you made, it's a horrible store of value. That may be true. And so if you and I...
really, not to interrupt, but to be clear, just when I say horrible store of value, what I'm really attacking is this idea that you can't have something cannot be categorized as a store of value when it has tail risks, meaning extreme ups and downs. Bitcoin, I've always argued, is an investment, not a store of value. Store of value implies you can't have extremes. That's more my contention.
I hear what you're saying. And what I was going to say is, just because it's not that today doesn't mean it won't be in the future. And so we have to grow, and over time, so it's evolving. And so we can see it was having 95% drawdowns, and then it had 85% drawdowns, and then 80% and 75%. Now we're down to about 70% drawdown. So we can see the volatility is dropping. But just because it's not... And so money also has this evolution process where it starts as a collectible. If enough people collect it, it could evolve to a store of value. And then if the store of value is used enough and it's broadly recognized and it has the attributes of money, portable, divisible, durable, et cetera, it could potentially evolve to the next stage, which would be medium of exchange, and then eventually could evolve to what we would call a unit of account. So I believe Bitcoin has all the attributes to go through that whole evolution process. It's certainly not there today. So I'll agree with you, but just because it's not that today doesn't mean it won't be. The last thing I'd say before I answer the second part of the question is I'd also say that Bitcoin is a horrible store of value. It was 69,000 and today it's 24,000. It fell all the way down, but it was also $3,800 24 months ago. So if we zoom out and look at the lowest point every year, we see this amazing trajectory. So on like a 3-year time frame, it is the best store of value. On a 1-month time frame, it's a horrible store of value. So I'll leave it at that. Now to the second part of the question about all these people who come in overconfident and they use too much leverage and then it makes the market move up and down. To somebody such as yourself who's much more a little bit more active, or other people listening to this, that's a huge opportunity. So I like to think of volatility as the difference between perception and reality. So the reality is that the way that we look at new technologies is we don't want to look at the price. We want to look at the network growth, network effects, and we want to look at the development on the network. And so if the reality is the network has been growing at a tremendous rate, we can see that through the mining hash power, we can see through the number of wallets growing, et cetera. So the network is growing super fast and the development on the network is happening super fast. So the reality is that we're going up and to the right. The difference is perception. To your point, people get way too overconfident. This is going to happen overnight. I just know it. It's to the moon, right? And then they jump in, they use a bunch of leverage, it pushes it up too high. And then markets run out of buyers, it starts dropping. All those people drop out, and then it gets oversold. So Bitcoin continues to get overbought, oversold, even though it's moving up and to the right if you zoom out and look at it over, a monthly or yearly basis. So that is an opportunity, right? Volatility is the opportunity for us to know that the reality is moving up and to the right. The perception gets overbought and oversold. And so those are good buying opportunities for us if we can understand that. I don't know if that answers your question. Right.
Yeah, no. There's a lot that I agree with, and some things we can debate on. But I think it's good to kind of have I'm a big fan of definitions. I made this point that's like when definitions change to suit a certain sentiment, that's when society collapses. The moment you lose words, you lose all kinds of constructs around words. But that's why I always have such an issue with narratives. But let's get back to some of the audience.
Before you ask your next question, I want to just do a shameless plug because what you just said I agree with 1,000%. And so the new book that I just put out last week, it's called The Uncommunist Manifesto. And we actually start the book with definitions for that exact very reason. So we actually start with definitions so we could all be on the same page as we go through the book. Because to your point, so many people have different definitions. And so I agree with that 1,000%. We wrote that book for that very reason, putting the definitions in the front.
By the way, another shameless plug. Everyone follow Mark here on Twitter and obviously subscribe to his YouTube channel. As you can tell, very thoughtful in the way that he views the world. Let's go back to some of the audience. So let me turn that, because I think I know the direction you want to go. So from Mark, first on the Eurodollar, I know you had Jeff Snyder on recently on your YouTube channel. I had him on a space as well, but maybe touch on the Eurodollar part, and then Weimar, I'll kind of readdress it relates to Japan. But Mark, go ahead.
Yeah, I mean, I think the Eurodollar and the Japan are both similar situations. Obviously, they're different, but I think they're similar to the Eurodollar market. Yeah, I did have Jeff Snyder on, and he's brilliant in that regards. For me, I take a little bit like, so what kind of a viewpoint on that. And so we can get technical into the weeds on that, but like, I don't know if it really matters that much. I mean, the Eurodollar market is big. What I see, I guess the way that I'm looking at, if we want to jump into the European situation and the bond situation, which obviously has a lot to do with the Eurodollar market, is, obviously there's a shortage of dollars out there, and the shortage of dollars is caused by a lot of things, but mostly I think it's caused by people wanting to jump into treasuries, and they need the dollars to buy the treasuries, and that's caused it. And then we have this big European bond crisis. I made a video talking about this specifically, and how the European Union, I think, is on the verge of breaking up and collapsing because of this bond crisis. And it's really being exaggerated by these new tools they just put into place called these fragmentation tools. And so we have the PIGS nations, Portugal, Italy, Greece, Spain, that they just can't really carry their weight, right? They're constantly too much debt, not enough income. And then you have the productive nations like Germany kind of carrying the weight for them. And so now they have this fragmentation tool where let's take from the nations that do good, like Germany, and let's give to the nations that do poor, like Greece. And I think that's only going to exaggerate the situation and really break the European Union down. Then you throw in the energy situation with, Germany and gas, et cetera. And I think you really throw fuel to the fire. As far as the Eurodollar market specifically, I also see that coming under a little bit of an attack. And when I say it's under attack, I've made some claims that I think the Fed is maybe doing this intentionally. And so we saw in June of 2021, Jay Powell from the Fed and Christine Lagarde from the IMF had a meeting. And in that meeting, Christine Lagarde was telling Jay Powell that, we're doing this green energy transition, and that they want to spend somewhere between 150 to 176 trillion dollars on this green transition over the next 30 years. And Jay Powell in that meeting said, we're not doing that. As a matter of fact, the Fed has dual mandates, one of which is not a green energy transition. We're not doing that. Good luck. And the very next day after that meeting, after that statement, that's when they started to raise the overnight rates, which started now draining all the liquidity out of Europe. Now, why would the Fed do that? In my opinion, what I think is the case is that, just like if I jump to Bitcoin as an analogy for a second, most people would say Bitcoin will never succeed because the central bankers will never give up control. They'll never cede control to Bitcoin, and so they're going to fight it. And I would agree that that's a valid case. And if that's the case, then I would also say, well, then why would the Jamie Dimon New York Fed give up control of the dollar to the Euro Davos group? And their answer is they wouldn't. And so the Euro Davos group wants to print all this money to push this whole transition, and the Fed wants the dollar to remain strong. And so I think the euro is coming under attack by the Fed. I believe that they're going to continue to raise rates and continue to drain liquidity out of the market, which will continue to put a hurt on that market, and we'll continue to see those yields invert. So hopefully that answered the question. Yeah, I think that's a big problem, not only because of Taiwan, but also because of Russia, Ukraine. And so we look at Taiwan making the majority of the microchips, which the US is coming on board. I'll talk about that in a second. But so we see, obviously, Pelosi went to Taiwan. China's now running drills around Taiwan, right? The islands around it. There's missile tests going on over the island. That's not a good situation. It could really hurt it. But also on the other side of the world, in Ukraine, 60% of the neon gas of the world is made in Ukraine. Well, what do we neon gas for? We need the neon gas to make the microchips. So we're actually being squeezed from both sides. 60% of the neon gas in Ukraine, and now the microchip processing in Taiwan. I think that's bearish for sure. That's not a good situation. We saw used car prices rise over 35% in the United States, mainly because of new cars not being available. Why were the new cars not available? We had finished cars on lots, but we'd had no chips to put in them. And so I see more supply constraints. I see more squeezing. I see more shortages. And I'm bearish on that. And it's part of the reason why I've made this statement, and I continue to build on this thesis that I think we might be at the lowest point of inflation we'll see for the decade. Everyone thinks inflation has peaked and it's coming back down. I think inflation is probably going to be low today for where we'll see it by the end of the decade. And the reason why I say that is because of situations just like this. We're going to continue to see microchips getting squeezed. We're going to continue to see all types of commodities getting squeezed as this world continues to break apart, like we're seeing with microchips today.
It is interesting. It is an interesting thought experiment. I hadn't thought this myself, but if we go with the narrative that there are these, again, longer form cycles, there are cycles in technology, there are cycles in geopolitics, new world orders, new alliances. Well, I don't recall if there's ever been a time like what we have now, where the cycle of the geopolitical landscape changing has impacts on the technology cycle, right? From a longer term perspective, to me, it's just an interesting thing to maybe think through as far as that intersection of cycles kind of bashing each other.
The last time those cycles converged, because remember they run on different time periods, the last time they converged was about 250 years ago. And that was at the start of the Industrial Revolution. And we can see how the entire political landscape of the world changed, because what happened is, using that new technology of machines, people started moving from the fields and the farms, the agrarian age, decentralized. They started moving into cities because of factories. And it led to this huge centralization effort where now you had to live in the United States, but not just in the United States, you had to be in New York or Chicago or San Francisco to make money. And what that does is that allows the state to grow really big, because all that power and wealth is centralized within it. And now it can easily extract that wealth. But now, as that swings the opposite, and now people are last week, there was an article, I think in New York Times, that came out, talked about how people in Mexico City are so mad about all these digital nomads. So now we have people moving all over the world, decentralizing, and that makes it very difficult for the state to extract wealth from them. The returns on violence are low, as explained in The Sovereign Individual, the book Sovereign Individual. And so again, back to the question you asked, the last time we saw this converge was 250 years ago, and it changed the whole landscape of the world. And now we're seeing it converge again, and it's going to go the opposite direction, and it will also change the political landscape into a much more decentralized world. Yeah. Two really good questions. All right. So the first question is, with the currencies collapsing, will they collapse with the situation in China and Japan and Europe, as we've kind of already talked about? And then if so, does the Fed step in, and then do they blow things up even more? So let me talk about that for a second, and then we'll get to the second part about the trust and the surveillance and things like that. That's a very important topic. But the first one, just real quick. So with the situation in China and Europe and Japan, et cetera, will things blow up? Yes, 100%. 100% they will. There's no other way. And I say that very confidently. What happens when you expand the monetary supply and you expand the population at the same time? Well, you have massive growth. Well, what happens when you shrink the monetary supply and you shrink the population? Well, you get the opposite of growth. So we can look at it from a couple ways. Harry Dent wrote a book a number of years ago called The Demographic Cliff. It's a very important indicator to study if you want to see where the world is going. Peter Zion talks about it in his new book as well, The Demographics. So demographics are the makeup of the people, the age. People are different, but their spending habits are very predictable as they move through life. What we can see in China, and most developed world for that matter, but China for a second has a very big problem on their hands, where for 40 years they had a one-child policy. So that means that they're missing an entire gap in their demographics. They need 30 and 40-year-olds, and they don't have any. Now, they can go have as many kids as they want today, but it doesn't matter. They need 30 and 40-year-olds. It's going to take 30 years before they have them as adults. And the problem is they have this giant aging population with nobody below them to come support them to build the economy, to pay for them, et cetera. So just looking at China alone, in the next 25 years, half their population is gone. Just timed out. That's it. They just die, and there's not enough people to come up below them. So the world, the leaders, the World Economic Forum would have you believe that overpopulation is a problem, and we need to deal with that. But I think, as Elon Musk has been banging the drums on lately, depopulation is actually a much bigger problem that the world is facing. So that's a massive problem. So that's happening through the developed world. The US is a little bit better. We had what's called an echo boom generation. And so the millennials, so we have about a 35-year buffer before we have a serious problem. So Western Europe, Japan, China, they're all having this massive demographic cliff of this depopulation problem. At the same time, the money system is crashing. So we see in China, they're way worse off. Their debt is double, actually almost triple what the United States is. Now their banks are running out of money. They have these $1 trillion holes, the $1 trillion in the real estate bubble that's popping. They have $1 trillion in this high-speed rail system they built that's blowing up. And so they have massive holes in their demographics and their money supply. So the money supply is coming down, the population is coming down. Japan, Europe, I already talked about the European situation. So we're going to be in a situation where the Fed is going to either, one, have to bring that debt onto their books or not. Either way is a horrible outcome. And that's just where we're at. It's just math. Those are the two options. You either print and you bring it on, or you don't, and either one is really bad. And I think either one proves the need for why we need real hard tangible assets, gold, natural gas, oil, and of course, Bitcoin. Now, back to the second part of the question, which is Bitcoin and other cryptocurrencies and surveillance and things like that. So the nations of the world, they really want to rush out these central bank digital currencies, these CBDCs, which are horrible. They are surveillance tools. It's programmable money, meaning they can program it any way they want. Hey, we're going to send out stimulus, but if you don't spend this money by Friday, it automatically comes back to us. Hey, you can spend your money here, 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 but you can't spend it here. Hey, we think red meat's no good for you anymore, so you can't buy red meat anymore. Hey, staying out after midnight's no good. You can't spend after midnight. Hey, you're this minority or whatever, group, we're going to give you reparations or whatever. And so it becomes a very unfair system, and it's total surveillance as well. And to the point of your question, a lot of these cryptocurrencies could also be used in that way. And so it could be dangerous. Bitcoin is different in a sense where nobody can control it. And so there is no ability for the government to program money against you. And so those will be the two options. We can use tool A, we could use Bitcoin that gives us freedom from that whole system, doesn't give them power to manipulate us that way. Or we could use the central bank digital currency that will have 100% total surveillance. And what they're hoping to achieve with that is the reason why central planning always fails is they don't have enough data. And they hope, and if you read Klaus Schwab from the World Economic Forum, he wrote a book called The Fourth Industrial Revolution. If you read that book, what he hopes is, or what they're planning to have, is this giant AI cloud that collects all this data. If they can see everybody spending through central bank digital currencies and feed it all into this AI cloud, then they'll have enough data to manage the society better. And so we're going to see these two different things in stark contrast, and we'll be able to choose which one we want based off of if we want freedom or slavery.
By the way, that point, I'm glad you mentioned that point, because back in June of 2020, as we were still coming out of the low for equities, I put a piece out on Seeking Alpha, basically saying the only way out is hyperinflation or defaulting to the Fed. Because when your starting point for so much leverage is so high, you don't resolve that by being in the middle. It has to be something extreme over some period of time, and who knows how it's going to play out. But I think that's worth keeping in the back of everybody's minds.
Well, I think we know how it plays out. Real quick, I think we know how it plays out. I think the IMF put out a paper in 2015.
Well, yeah, right, exactly.
Right, they tell us it's called financial repression. Right, so we're gonna have crazy high inflation. We're gonna keep the bond rates low, and we're gonna force everyone to buy bonds, and we're gonna steal all their wealth. We've seen it happen in the 40s, and most likely we're going to see that again. It's their only option, short of defaulting, right? And no one's going to default when you have a money printer. So you're going to do financial repression. So I think that's nothing in life is guaranteed, but that's the most likely outcome. That's my base case anyway. And so then, we can develop a investment plan based off of something like that. But anyway.
Yeah, no, I hear you.
Okay, so first off, let me make this little side note. So Bitcoin, when we look through monetary history, we can see different things were used as money. Obviously, gold was emerged as money, and for 5,000 years was used as money. But gold doesn't have the velocity, so it's very slow. So we had to add debt as a layer on top of gold in order to get the velocity. Bitcoin is the very first asset we've ever seen, back to technological revolutions. It's the first asset we've ever seen that doesn't need debt in order to add velocity. So Bitcoin could be a store of value and an instant medium of exchange at the same time. So we've never seen that before. So that's an interesting tidbit to the point of you're asking about velocity. And then to the second point about couldn't the government use it? I guess I don't know which way you're referring to. So a lot of people think that the government probably has some backdoor. The CIA created it. They could use it. They could manipulate it. They could co-opt it, so to speak. And they don't have the ability to do that. We know that's not the case because Bitcoin code is open. And so anybody can inspect the code, unlike other cryptocurrencies that are proprietary. So we know they don't have any control over the network. Now, could they buy large sums? Could they use, paper trading, futures, et cetera, ETFs to manipulate the price like they've done with gold? They certainly could do that, right? So they could try to manipulate the US dollar value of the coin, but they can't manipulate the network. But could they, through a series of booms and busts, wreck the network? I mean, they could certainly try. Was that your question, just for clarity before I answer that part? Right. Okay. So right now, Bitcoin's about half a trillion. So it's not trillions, but half a trillion. If you add the whole cryptocurrency market cap, you're a little bit higher. But so what I would say about that is, could they legislate? So I guess that's really the question. Could they regulate it out of existence? Sure. They could say, hey, if we catch anybody with Bitcoin or cryptocurrencies, we'll kill them on sight. They could certainly do that. I don't think that's probable. Anything is possible. I don't think it's probable. I'll tell you why real quickly. A couple of reasons. One, look how well that's worked for drugs. Since 1971, they started the DEA. They spent trillions of dollars to keep drugs out of the US. Drugs have only become bigger, right? Today, 18 to 35-year-olds, the number one cause of death is drugs, right? It's fentanyl. And so they can't stop that. They can't even keep it out of a prison. And drugs are physical. They have to be grown, cultivated, packaged, shipped, processed, smuggled, et cetera. Bitcoin's completely digital. That's one. Two, when they tell you not to do drugs, doesn't make you want to do it. But when they tell you you don't have the right to hold your wealth in a way we can't steal from you, it sort of makes you want to do that. Like every time they talk about gun control, we see gun sales go through the roof. But then even more practical reasons, I think, is one, the questions that were just asked previously to your question were about what can the Fed or central banks do to keep the markets from crashing, right? So most people have a bias or a base case that the central banks don't want the game to end. They want it to keep going. And if that's the case, if they've spent, collectively between the Fed and the government, $7 trillion in the last 24 months to keep the markets from crashing, and then to your point, they suck that money out, they regulate out of existence, they would cause trillions of dollars to evaporate and crash the very system they're trying to prop up. That seems very counterintuitive. The other thing I would say is that, so that's probably why they wouldn't want to, but then I don't think they'd be able to, because we have about 36 high-ranking senators and congressmen that are Bitcoiners. So there's a lot of opposition inside there, entrenchment as we call it. But also, we've seen the financial industry completely entrenched. BlackRock just announced that they set up Bitcoin trading just last week. So who runs, if you understand how the laws are made, they're made through lobbying. The financial industry is one of the biggest lobby groups. So when you have Fidelity and you have BlackRock and you have Goldman and you have US Bank and all these banks in Bitcoin, they've spent billions of dollars collectively to bring those services on. They write the laws. So even if they tried to pass these laws, the entrenched senators and congressmen would fight back. Two, the banking industry would fight back. And three, we have over 25 million Americans that own it. They would fight back. And then four, even if they did, they'd crash the whole system they're trying to prop up. So I think the probability of that happening is very, very low.
Unfortunately, I lied about having one more question because I do have a hard stop here. But everybody, please make sure you follow Mark Moss on Twitter. Check out his YouTube channel as well. First time, Mark, you and I are speaking. I do appreciate you being able to join us here.
Thank you. Appreciate it.